In this lesson, we will talk about working capital and SPA definitions, legal agreement essentials AMP calculation, in sale and purchase agreements SPAs. Working capital is a carefully defined, transaction-specific metric typically calculated as current assets excluding cash minus current liabilities excluding debt, used to ensure the business is transferred with a normal level of liquidity. The SPA details which accounts are included, excluded, the calculation method, and how working capital adjustments affect the final purchase price. What is working capital in SPAs? Working capital in the context of SPAs and IMPA transactions is a negotiated financial metric representing the difference between a company's current assets and current liabilities, with specific inclusions and exclusions tailored to the deal. Its primary purpose is to ensure the buyer receives a business with sufficient liquidity to operate normally post-closing, and to adjust the purchase price if the actual working capital at closing deviates from an agreed target or peg. SPA-specific definition example: net working capital means current assets excluding cash and income tax receivables, minus current liabilities excluding funded debt and income tax payables, each determined in accordance with seller's historical GAAP consistent policies listed in Exhibit A and drawn from the trial balance accounts in Exhibit B. In SPAs, current assets typically include accounts receivable, inventory, and prepaid expenses while excluding cash and securities. Current liabilities generally consist of accounts payable, accrued expenses, and customer deposits, excluding debt and tax payables. Specific exclusions such as cash, debt, related party balances, and deferred taxes are often explicitly stated in the SPA. To avoid ambiguity, it is a best practice to attach detailed schedules listing included and excluded accounts, along with sample calculations, ensuring clarity in the agreement. To calculate working capital in legal agreements, first define which current assets and liabilities are included or excluded, typically excluding cash, marketable securities, and debt. Use the seller's historical accounting policies or GAAP as specified in the SPA. Apply the formula net working capital equals accounts receivable plus inventory plus prepaid expenses plus other included current assets, accounts payable plus accrued expenses plus other included current liabilities. Set a target peg by averaging historical balances adjusted for seasonality and one-off items. At closing, prepare a balance sheet using the agreed definition. The purchase price is adjusted by the difference between actual closing working capital and the target. If actual exceeds the target, the buyer pays the seller the excess. If less, the seller reimburses the buyer. In SPAs, the purchase price is adjusted post-closing based on the difference between the estimated net working capital and the final net working capital, typically determined within 60 days of closing. The target peg is based on historical averages adjusted for seasonality. The adjustment formula is actual NWCI target (NWC), with no adjustment within a specified collar, e.g. 5% of the peg. Dispute resolution provisions include timelines for review, objections, and escalation to a neutral accountant or arbitrator to resolve disagreements. In SPAs, clarity is essential: clearly define included, excluded accounts and calculation methods. Consistency in accounting policies, typically using the seller's historical practices, prevents manipulation and ensures comparability. Attach detailed schedules and illustrative calculations to the SPA for transparency. Include dispute mechanisms with timelines for review and escalation to resolve disagreements efficiently. Normalize the target working capital by adjusting for seasonality, one-off, or non-operational items to ensure fairness in the purchase price adjustment process. Key SPA working capital essentials include defining net working capital as current assets excluding cash, minus current liabilities excluding debt. The target peg is based on historical averages, adjusted for seasonality. Adjustments use the formula actual NWC target (NWC) with no changes within a collar, e.g. 5% of the peg. Accounting principles follow the seller's GAAP consistent policies detailed in the SPA. Dispute resolution includes review timelines and escalation to a neutral accountant or arbitrator. Schedules provide detailed mapping of included, feeded, excluded accounts. Working capital in SPAs is a negotiated transaction-specific metric distinct from standard accounting definitions, designed to ensure the business is transferred with a normal level of liquidity. The SPA must clearly define the calculation method, included, excluded accounts, and adjustment mechanisms to minimize disputes and align both parties' expectations. Properly structured working capital provisions are essential for a smooth post-closing transition and fair purchase price adjustment.